Welcome everyone to what to expect out of the markets in 2025. Tariffs, debt, interest rates hold the key to the coming year. How a change of government could affect investors. Ironically, this was sent out before the announcement that Trudeau plans on resigning, and there'll be a leadership convention. So let's get right into it. I gotta click on here. We'll start with how the markets did last year. I'm in the business of what have you done for me lately? So we'll talk about last year. It was a pretty darn good year for us, for our clients, far above average. Let's go with the Dow Jones, which has been around since the 1800s. It is the 30 of the largest U.S. stocks. It's done by a committee by Dow Jones News Services. Toronto Stock Exchange, 17.99, a very good year. The S&P 500, 23.31. We'll go through this in a second. Now, the S&P 500 equal weight, the Dow Jones is a price-weighted index. It does not overweight Apple differently than a bank stock. They're really 30 stocks, but they don't get weighted by market size. If we look at the S&P 500, it is dominated by Apple, NVIDIA, which makes computer chips, and the hottest stocks. So if you bought the S&P 500, you made 23%. If you bought the Dow, you made 12%. And if you bought the S&P, all 500 stocks, but you didn't have a whole bunch more in Apple than you did in something like Bank America, you made 11%. The Russell 2000 of about 2,000 smaller cap, kind of $1 to $5 billion companies, 10%. As you know, we've liked very much Canadian preferred shares. That's the index itself, as measured by the iShares preferred Canadian index, 16.8. Now, these are all price points, so they don't include dividends. So including, tech stocks typically don't pay a dividend, but Canadian preferreds have been paying 6-ish% dividends. So well over 20% in Canadian preferreds. Fourth year in a row of terrible returns for Canadian bonds. 0.6% on the iShares Universal, and the long bonds were minus 4.6. That's Canada. U.S. Treasury bonds, fourth year in a row of minus returns in the bond market at minus 11. Now, this is very interesting because it's quite a bifurcated market. We just talked about how the United States, where the smaller caps, the equal weight was kind of a 10 or 11, 12% return. The world, this is the world index outside of North America. So if you bought the world without U.S. stocks and Canadian stocks, it was really flat on the year. Gold having a good year at 27%. Oil really finished flat on the year, and the Canadian dollar lost relative to the U.S. dollar about 7.8%. Now, it's interesting, I didn't put this up here, but the U.S. dollar index, we call it the Dixie in trading world, the U.S. dollar index, gained about 5%. So Canada did a little worse than the rest of the world, but there was a trend of U.S. dollar strength last year. So let's get into the playbook. As you know, I like to go through it history. This is a very, thank you to my son Alex for finding this chart. This is, we had Trump 1.0, and one term in office is really not a data set, but it's uncanny if you look from September to Inauguration Day versus the first time he was in office. Now, this is the U.S. dollar, and you can see very, very strong U.S. dollar going in right to about Election Day. Now, Trump does not like a strong dollar. He likes a weak dollar. He likes to have his export be competitive in the world. So, of course, on Inauguration Day in 2017, he said the dollar is too strong, and that actually was the peak of the U.S. dollar. So we're going to look at a playbook. We're going to look at a number of factors. But if we go with the last data set, I try to answer the questions as we go through the presentation. We had two questions. One was, boy, the Canadian dollar has weakened. Should we take our 1.42 and buy US dollars? The other question is, boy, the Canadian dollar looks weak going forward. Should we just buy US dollars? I'll say that I'm going to well, I'll touch base on it again. Let me get through some of these slides. Playbooks. US, let's look at the returns of the last several presidents. So let's kind of focus in on the rate of return from inauguration day, which is your start line, to 48 months into the term, which is your 4-year term. The winner was actually Barack Obama, followed by Bill Clinton, but Trump beat Joe Biden by just a couple of percentage points, but most of them all fell very, very similar. The exception was poor George W. Bush. Now, was it a presidential issue, or was it that George Bush took office in January of 2001? Well, I think it has more to do with he took office of January 2001, and we were just rolling off the internet bubble. Yes, 2001 was a down year, but so was 2002, 2003. So we had 3 years where the markets did poorly. So that's kind of your playbook of just the history of presidents. We see a history of Trump, where a strong currency followed by a weak US dollar. Let's look at another piece of playbook. We just had the S&P 500 go back-to-back years of 20% returns. Let's look back to 1879, and let's look at all the times where the US market did back-to-back returns of over 20%. And you can see that we have very different results. Minus 31 in 1937. The recession was ending, and that's a curious one, and I'll talk about it in a second. 1937 was the minus 31, and we had a plus 33 in 1997 following back-to-back years. The average is only 4.2, so we're almost looking at half. The average return of the S&P 500 has been about 8% for the last 150 years. So we're looking at, on average, if we just say, okay, what happens? The markets have averaged less return. Now let's look at the outliers, 1937 and 1997. 1997, we were just starting the internet. I remember a friend of mine, Dan, was talking to me about this thing that I'd never heard of. So we were really ramping up that internet bubble. And again, the internet turned out to be everything we thought it would, but you had that 3 years. 1937 is really the start of the Great Depression. And let's remember that 1930 started with a recession and turned into a depression. It's a little troublesome because the real reason, if you look throughout history of 1937, the real reason for the Great Depression was massive US tariffs, and it started a global trade war. The tariffs on if you want to Google Smoot-Hollings, this was the act enacted to really mitigate the recession, and the recession turned into the Great Depression. So the market had fallen in the early 30s, rebounded. It looked like the economy was rebounding. Tariffs came in, and the whole world went into a global trade war. So it is a little troubling, given the fact that we have a president that loves tariffs. Maybe he should tune into this presentation. Okay, let's look at another piece of playbook. I've talked about this. I'm going to show a different way. I've talked about this in the last several calls. The S&P 500 is far higher than it has been on an historical basis. So if we look over here, we look at the current valuation in terms of price earnings multiples. It isn't the highest in history, but it is near the highest. And then we look out 10 years later, what have been the returns when you start investing with the S&P 500 at these kind of valuations? So some of the calls were coming in is, what about the overvaluation of the market? You can see here a scattergram when the S&P 500, you start investing, in 10 years later, you can see we're kind of 0 to 1% is the expected 10-year return. On the last call, I projected the Goldman Sachs expected return of about 3% for the next 10 years. Market's even gone higher since the last call. And so here we are, the expected return. You can see over here, if you start with low valuations, the S&P can give you a 20% compounded 10-year return. High valuations, it's kind of makes sense that you're going to have better lesser returns when you buy highly valued, and better returns when you buy bargains. Okay, so one of the things, again, Alex, thank you for sending this in. This shows you U.S. flows into equities, and that's the top scale. And you can see that we are near records November 08. Well, that was right before the 09 crisis. Terrible time to buy stocks. You can see when there's massive inflows into stocks, you tend to be at a high point. The bottom of the chart is kind of the inverse. We talk about money has to go somewhere. And when rates are low, money tends to flow into stocks. This is the allocation of people that are buying, putting their money into cash. And you can see that, there's April of 2020, there is COVID. I want cash, I don't want stocks. It was a generational buying opportunity, yet people said, I want stocks. The record was actually September of 2022. The markets were weak. People again flowed in. And the other thing we saw was rates were starting to ratchet up dramatically. And so people said, I want stocks. Both excellent buying points. You can see that today, or last month, we were at the near lowest level in history of the percentage of money that is in cash. If it's all in cash, I talk about the swimming pool. Over here, we got to bet on the water level of the pool. Everybody's in the pool. The water levels, it's going to be hard for it to go up. And at some point people are going to jump out of the pool, and I don't know when that is, but we have a weak tape today in the markets, and that's not unexpected. I'll give you some kind of exciting news for me. And my clients from the 1990s and 80s even, and yes, most of them are still clients, will remember that we owned far more bonds than we did stocks in the 80s and 90s. And if we look back at this chart, we can see that we have treasury yields here and the earnings yield of the market. Now, don't mistake this with dividend yields. We're used to hearing what's the price to earnings ratio. I just showed a chart of the price earnings ratio. But if we flip that on its head and we put earnings, profits, and then we take the value of the S&P 500, you get an earnings yield. If we bought an entire company, what would we make? Well, if we bought it at 20 times earnings, our first year on profits would be 5%. So you can see here we favored bonds were yielding far more than stocks. And especially we went into the top.com bubble owning almost no stocks, owning mostly bonds. It was really skewed in favor of bonds. And then for 22 years, we have not owned bonds. The really exciting thing is that you can buy a U.S. Treasury bond today at 5%. Now, it might be a smidge under 490, but this is kind of exciting relative to stocks. Now, it's not as dramatic an undervaluation, so that doesn't mean you need to run from stocks completely, but it is exciting that you can buy a bond now. You can have it part of your portfolio. Again, we've had 4 years, consecutive years, where if you own bonds, you've had years and years of doing horribly. It's been a real drag on your portfolio. Our clients, we haven't had any exposure. We went to zero exposure other than just if you owned a 1-year bond for cash or something. But at the end of the day, we haven't experienced any losses in bonds. It's kind of exciting that you can own a bond, you earn 5%. Now, again, this is United States yields. This is not government of Canada yields. These are U.S. And so I'm looking at the U.S. market versus the bond market. So you will see in your accounts more movement towards the bond market and away from stocks. And it isn't going to be all in like we were in the 90s. We are all into stocks. Okay, what one of what else can we do? Because we're afraid of U.S. stocks. And again, I don't want to be completely afraid of U.S. stocks. I'm not particularly afraid of mid-cap stocks that have a good dividend or good valuation, but the market itself looks vulnerable to me. Deutsche Bank said is now overweight Europe versus the United States. Valuation, just one reason, but this is quite compelling. If we look at the valuation, again, we'll go back to the traditional method, price earnings multiple. The light blue line is the United States, and the dark blue line is Europe valuations. I've been talking to some clients about investing in Europe, which trades at about 13 to 14 times earnings versus 23. It's the greatest difference in the entire history of stocks. You can see back in 06, 2010, the valuation of the Europe 600 index and the S&P 500 index have almost been identical. They've almost traded at the same price earnings. Historically, Europe has traded about one price earnings point less. We're about 8 to 9 points less, never been this high. So while the United States market is historically richly valued, Europe is actually cheaper than it has normally been. I have one client said, I don't want Europe. There's too many left-wing governments. Another client said, oh, they have ultra-right-wing clients, political parties in there. Look, you can't get a bargain in the stock market unless there is a negative headline somewhere. I often say Unilever versus Procter and Gamble. One has a head office and an address in Europe. One has a head office and address in the United States. But they do. One makes Tide, one makes Sunlight. I'm not sure there's a great difference or huge difference in profitability. I'm going to go back to my favorite bond. My clients in the 90s, when the stocks were doing poorly, the internet bubble, know that we owned Government of Canada real return bonds. In the United States, they're called Treasury Inflation Protected Securities. And I'm going to walk you through this for a moment because I think it's really important that you understand them. And the more you understand them, the more I think you're going to like them. Okay. I'm going to give you an example here. Let's say we buy a bond that is 2% real yield. Real means inflation adjusted real yield. So you buy a $100,000 bond and you buy a 10-year term. Year one, you make 2%. So that's $2,000 of interest you receive in your account. And I'm going to use a 2.5% inflation rate. 2.5 is $102,500 after. That's your principal. So now you're $100,000. If you buy a GIC at 100, it matures at 100. Now you've got a maturing value that's rolling higher. After year one, your principal is now adjusted 102. Year two, should say 2.5 inflation. So now year two, you're at 104, 550. Okay. So if we go to year 10, your principal, you started earning 2,000, we got 2.5% inflation. Your bond matures not at 100,000, it matures at 128,000. Your final year of interest would be $2,560, not 2,000. So that is adjusted with inflation and the principal. So you get paid twice. It's pretty darn good in a market where the expectation is the S&P 500 could earn zero over the next 10 years. Again, we looked at the presidents. The exception of decent returns was George W. Bush. Why? We've got AI bubble. We had the internet bubble. I'm going to go back real world. There isn't actually a 2% bond that we could buy that was issued today. We've been buying, for example, a one that was issued at 1.75%, but we're buying it at 95.6 cents on the dollar, and the yield is actually better than 2. It's 2.29. I think that this is a piece of paper that, as the stock markets falter, people are going to go, wow, this is out there. I want to, again, since 1900, the industrialized world has averaged just 0.6% above inflation. That's in the risk-free world of government bonds. So yielding 2.29 is the only reason we can get this bargain is everyone's making so much money on Apple or Nvidia. So, you know, if that falters, I think that this is a piece of paper that you don't have to own for your 10 years. I believe if you sell it in 1, 2, or 3 years, and maybe we will sell them, I think you're going to get more than 95. I expect real yields to go back to about 1%, which would put these, you know, you buy it at 95, you sell it at 106. Pretty good return for the next couple of years. Um, touch on, well, let's go back here for a moment. Just about where we're going. You know, what do I see for the year? I see an economy that is muddling along. We got some job data today. Both in Canada and the United States, they created more jobs. One of the issues about inflation has been wage pressure. Typically, to kill inflation, you've needed to get the unemployment rate up. It's horrible to say that there's almost a deliberate attempt to create unemployment, but that's in fact been the case. So this magical soft landing where we just slow the economy down just enough, it's occurred rarely. It occurred in 1994, 95. But it can also mean that inflation reaccelerates without the presence of a recession. So we're starting to see some evidence. With the jobs data today, the market has gone from expectation is several rate cuts into a situation where the market now expects just one rate cut this year. This is going to be a problem in Canada. Now, we've talked about this for a year now, or maybe more, about the fact that mortgages are going to reset this year, and many, many people have mortgages in the 1.5%, 1.75% range in Canada. And for my American clients that call in and think that their mortgage rate is stuck for 30 years, they're shocked that mortgages come up for renewal every 5 years. So during COVID, when rates went down to 1.5 to 1.75, these mortgages are going to come due. This was actually Mark Rinford dug up from a marketing piece that was many, many years ago, but it talked about risk return from a mortgage investment fund that actually has a diagram that says this is the risk. As the further out you go, the more risk. So Canadian stocks, very, very risky. They got T-bills, they got bonds. According to their marketing piece, the least risky thing you could do on the planet was buy their mortgage fund. And the return was higher than stocks and less risk. Wow. This is one of the mortgage funds that has now halted redemptions. You can't have your money, and there will be losses in that fund. They don't even know how big the losses are going to be, so they're assessing it, and you can't have your money, and there are no dividends. So we said this was coming, and since my last call, another one of the biggest in Canada, private sector, KingSett, halts distributions and redemptions of its flagship fund. If you want your money, you can't have it. We won't pay you a dividend. They had made a substantial loan to a Surrey builder called Tind, and it's placed under creditor protection. This was a multi-tower building. Interest is not being paid. So again, we don't even know what the losses will be, but there will be substantial losses. There is a financial planner out there in Canada that had specialized in mutual funds, and in their head office in Vancouver. I won't give you any names, but they run $16 billion, and they have almost half of their assets in mortgage investment corps and real estate assets. I feel that is a high risk proposition, and I feel that clients, if they're with that fund manager, that they should get out now. I have no insight other than we're a very weak market. We're very weak, especially on pre-sales. And you can see that this is going to be a problem in Vancouver and Toronto, and this is where most of the loans are. So I come up to my credit crisis playbook. Investment properties I've not liked. I think it's getting almost too late for that. It's very hard to find any bids on your condos. If you're buying GICs, please don't exceed your $100,000 limit. If your financial institution goes bankrupt and you have $100,000, you will be paid. If you have $500,000, you will get a check for $100,000. I've been saying this for over a year now. Mortgage funds shouldn't be in them. Ironically, I've said avoid subprime lenders. Canadian Western Bank is actually being acquired by National Bank. But we'll see if that closes. I have my doubts whether that even closes because, we already saw last quarter a large increase in loan losses. And we'll see if in fact National doesn't walk away from those deals. So I think that the whole market is not a bubble. I look at Canadian energy stocks. I look at the preferred stocks in Canada. And if we look at our preferred shares, you might say, wow, should we get out of that? We bought Enbridge preferred at 14 and it's trading at $18 or $19. And I still say, well, Canadian preferreds are still trading at today's prices where you're still getting dividends of 7%. I think that's an excellent a place to park money. And if we look at the United States preferreds, they're trading about 24, and they have actually reset rates that are actually inferior to the Canadian rates. So, we bought the Morgan Stanleys and the Goldman Sachses at $18 back in the COVID crisis, and we sold them at 23 and 24. The Canadian preferreds are still trading down to the levels that the US ones were in the COVID sell-off. So I still think there's money to be made there, money in Canadian energy, United States industrials. Europe looks very appealing. It's just we have to think outside of the playbook. I look at US and I know Canadians are overloaded in US stocks, and they're concentrated on Apple and Nvidia and Tesla and Netflix. I think the whole world, I don't think this is a Canadian. Can you imagine the Europeans? Their euro has gone from 160 to almost parity. So not only have they gotten the returns out of the United States market, they've had return plus 50% on their currency. So they're feeling kind of smug, and their own markets have done nothing for 5 years. So I think the whole world is overweight. The American individual investors are low on cash, high on equities. I think the whole world is overweight, but at the expense of their own domestic markets. So I think that I think we can eke out a good year. And let's remember that looking back at our client returns, they were generally around 10% in 2000, 2001, 2002. And this is a time where the stock market, the NASDAQ, fell 80% in value in those early 2000s after the dot-com bubble. And I want to remind everyone, internet turned out to be everything that people thought it would and then some. And I think that the AI bubble is the third great bubble of the last 100 years. And so I believe that we can continue to do well, but I just caution that the expectation, and there's nothing wrong with backing off the risk and owning some bonds here. I didn't like bonds at 1%. In fact, I hated them, but I don't see the same kind of losses in the bond market. And let's remember, if the United States economy falters, bonds are going to go higher in value. So that's the playbook for I'll just touch quickly on the Canadian you know, again, we didn't know that there would be an announcement of an imminent resignation by Trudeau. The Canadian dollar, I haven't given you a definitive answer. The Canadian dollar actually has a seasonality that goes from January 1 to end of April, and it corresponds with the price of oil. The price of oil tends to be strongest from January to April because we need oil for the summer driving season. But we don't refine the oil during the summer driving season. We buy it in the winter and then refine it. So that this period of strength, the Canadian dollar, it's the biggest single daily factor affecting the Canadian dollar. We export 4 million barrels a day to the United States. That creates a demand for Canadian dollars. So all things being equal, the strongest period of the Canadian dollar. Now, that being said, I listened to Trump's speech last night on tariffs in Canada, and it didn't sound like he was joking. It didn't sound like, well, if we secure our borders. I also think he doesn't like Trudeau, and I think he would like to see Trudeau gone. I mean, let's remember, Nixon hated Pierre Trudeau. And I think it could be quite painful for Canada. So on one side, we've got stronger oil. I also think that Trump will likely fill the strategic oil petroleum reserve, which is what they keep on reserve for defense issues. Biden drained it. He wanted oil low. He drained the reserve. They need to refill it, and they need to refill it soon. You tend to find that presidents refill the reserve of oil at the beginning of the terms. They don't want to create a spike. So we could see higher energy, and it could create a demand for the Canadian dollar. And let's remember, on the election call, the day that Trudeau announced that he intended to retire, the Canadian dollar went up. So we might see a situation where the Canadian dollar strengthens, but we also could see a situation where if Trump really comes through with these tariffs, the Canadian dollar could weaken quite a bit. So I haven't given you a definitive answer, but I need you. I will continue to straddle both sides for our clients because there's risks in either direction. So that's it, everyone. Stay with the program. You'll see some changes in the account. When you look at your statements, you'll see some of these Treasury inflation bonds. Very excited about those. I think they're going to go up in value. And again, if I didn't get to your question or you have any specifics, drop us an email, let us know, and we'll get to your specific needs. Thanks, everyone, and we will see you soon. Talk to you next time.